It's Monday, April 15th. Welcome to Market Foolery. I'm Chris Hill. Joining me in studio today from Motley Fool 1, Jason Moser, and from Motley Fool Supernova, Matt Argersinger. Good to see you guys.
Hey. Good to see
Happy
you.
Tax Day. If you're one of our dozens of listeners in Massachusetts, Happy Patriots Day.
Right. Boston Marathon
The
is
Boston
today.
Marathon is going on, and two of our colleagues are running it, Matt Koppenheffer and Seth Jason.
Wow. Good luck, guys.
Good luck to both of them.
Heartbreak Hill. They're probably already through Heartbreak Hill by now, but God, that's a tough one.
Well, so I went to Boston College, which is where Heartbreak Hill ends.
That's right.
And so I remember my sophomore year and my senior year, my friends and I would watch the marathon right over the sort of the final ridge of Heartbreak Hill, and people were just so excited to be done. There was people were the looks on their faces. Yes, we were.
I just went through hell.
We were college students who may or may not have been consuming alcohol before noon, and cheering them on. But people were so happy to be going downhill.
Do you think that same level of excitement applies to today being tax day? People are just so excited to have it finished. I mean, I know I was pretty happy to throw that check in the mail and finally be done with it. I mean, while I'm not happy to be putting the check in the mail, so to speak, I mean, at least it's not something that I have to worry about tomorrow.
It's done. No, I think for most people, taxes is just sort of the one big thing you have to do every year that nobody looks for.
I feel like if you're cutting a check and putting it out there, then at least send me like a T-shirt or a koozie or something. Like,
Thanks
I paid the
IRS.
tax man. It's something. Let me get something out of it.
You want some IRS branded swag? That's what you want?
I mean, it's just a thought.
All right. We're going to talk bank earnings. We're going to talk gold, which we rarely, if ever, talk about, and one CEO's letter to shareholders. But we're going to start in the world of telecom. Shares of Sprint up more than 13% this morning, and that is because Dish Network has made a bid to buy Sprint for the cool sum of $25.5 billion. And Matty, you and I were talking about this earlier this morning. My first blush take on this is Dish is just swinging for the fences. They are just swinging for the fences on this one. Is this going to work? This seems like a risky bet.
I think it's a bet they almost have to make because this is where the industry is going. We've seen so much consolidation in the space, and what consumers want. If you think about us as consumers, we have a phone line. Usually, we cellular line these days. We have cable TV, we have internet or satellite TV, and it's kind of like we want all that to come into basically one hole. We want to pay one price per month. We don't want to have all these alternate subscriptions. So there's that whole bundling aspect, which a lot of these service providers have done. Dish kind of needs to do that to remain competitive, but also this is a bit of a wireless spectrum play. We've kind of heard about the shortage in wireless spectrum and how it's very competitive right now. By doing this deal, Dish can kind of get combine theirs with Sprint's cellular spectrum, so it's more airwaves, which is more valuable assets, and Dish has got the balance sheet to do a deal this big. They kind of need to do it.
Yeah, I agree. I mean, they have a pretty solid subscriber base in television viewers that subscribe to Dish Network currently, but it is all about bundling, and we see it either through Comcast or with Verizon Fios. They've done a tremendous job in bundling those services and giving us as consumers that great option there. And the problem with Dish is they were literally running into a wall at this point. What do they do next? Because it's one thing to be a Dish provider, but we know with this move to streaming and the internet for all of our television use. Obviously, AT&T and Verizon making tremendous investments in their wireless spectrum. Speaking of Fios, we know they're not really building out Fios anymore for Verizon because it's so capital intensive. So yeah, it's a play on that wireless spectrum. I think they're thinking about this correctly. They have the financial means to do it, and I think it's probably a good move.
And anytime you're in an industry where there is so much capex, so much investment has to be made, and networks have to be maintained. Anytime you can grab scale, which is essentially what they're getting with Sprint, that's a profitable. It's usually a good strategic move.
And there are other places around the country too that don't have the access to that cable, to those cable networks. I mean, there are plenty of places in the United States to date that still don't have the broadband access, and so I think that this is their effort to sort of help reach that contingency of subscribers that maybe can't quite get there, and so they'll probably gain a few more subscribers out of it, I bet.
There are so many companies on the competitive landscape who are affected by this. And I'm curious the extent that you guys think that some are nervous about this move, some are maybe applauding this move, like, yeah, go for it because we feel like you can't touch us. I'm just thinking about all the ripple effects, potential ripple effects, for not just Verizon and AT&T, but also, DirecTV. And, we were talking before we started taping about Breaking Bad and, like the entertainment providers, HBO, AMC, just all of these companies out there. Is there anyone who, at least for today, is less secure about their position, or is everyone just sort of saying, no, this is the first step, it's not a done deal, and we'll just see how this plays out?
Yeah, I mean, I think it is the first step. It's not a done deal, so very far away from anything being done here.
Because SoftBank has made a bid. For,
correct.
They could come back with another bid.
And I think, when you look at it from the perspective of talking about these bundling options, I think then you look at something like a Verizon or a Comcast, and they must be saying at least, there's another player out there. So, it's going to be potentially some competition, in that regard, which who knows? Really, but consumers, I think, could genuinely win from that just by bringing another option to play. But then I think that you look at things like your Netflixes and your HBOs and your Amazons, even to a degree with their Prime streaming, those types of options, AMC even, because there's more potential to get that product out to more people via this wireless spectrum, bringing more subscribers into the mix there. So those are potential winners, I think, from this. But again, very, very early stages, and we have a lot to watch play out.
Citigroup's first quarter profit was up 30%, better than analysts were expected, and the investment banking division seems to be getting it done there. We saw on Friday a couple other big Wall Street banks, J.P. Morgan, Chase, Wells Fargo, reporting. It seemed like the results there were mixed, and the shares were down, certainly Friday morning, sort of reflecting that. On the flip side, Citigroup, which for years seemed like it was in last place among the big Wall Street banks, or maybe not in last place, I guess I should say, more along the lines of maybe the last of the big Wall Street banks where you wanted to have your money. It seems like they've, dare I say it, turned a corner in the last 6 months. Any reaction to sort of how they're doing? I couldn't help but notice that since Vikram Pandit was either he resigned or he was fired, depending on who you want to listen to.
He's not there.
Shares up about 25% since mid-October.
Yeah, and that's like when the housing crisis hit and prices tanked. At some point things have to get better because they're so bad, right? And I think that's probably applicable to Citigroup here in some capacity. You're looking at a company here that over the course of the last 5 years, their top-line revenue has been basically cut in half, and their share count has increased by a factor of 6. So, shareholders have just gotten hammered by this company. And the biggest problem is with Citibank or any of these big banks really is that they are such black holes of information, and their performance is so dependent on the management teams that are behind them and the incentives that are in place for those management teams to perform. And I just don't really see any compelling reason at all for an investor to get behind something like a Citi or a Bank of America. Goldman and J.P. Morgan, we've talked about before, they're a little bit more, they're able to do some more things in their investment banking sides of the businesses than others. So I could see the investment thesis for that. But when I look at these big banks, I'm not interested in them at all. And I feel like if you need bank exposure, then you're better off just buying into a well-run insurer, because you're pretty much guaranteed that their portfolio is going to have some exposure to that. So.
And I think part of Citigroup's good results today, and I will point out, it's up today in what is a pretty ugly day for the market so far, and I think it's part of it was they released some reserves. They had banks reserve against potential loan losses, and these banks have been so conservative over the past few years for obvious reasons, because they wrote a lot of bad loans. And this is Citigroup saying, actually things are a little bit better than we expected. Less of our loans are going bad. That's a good thing. So they released that. So that helped profits. But, gosh, is that a really strong positive story? I don't know. Until
they do go bad, right? And so, we were talking about this, I think, on the radio show this week, and Ron Gross he made a good point. I think with these banks, you really want to pay more attention to revenue. And Maddie, you mentioned this last week, paying attention to that top-line revenue growth, because really banks can their earnings per share are, they can really kind of work those any which way, depending on the reserves that they release or how loans are performing or whatever. But, their revenue growth wasn't all that robust. And so, when you look at it from that perspective,
there was cost cutting involved, and that, that's one of those things that helps in the short term, but you can't cost cut your way quarter after quarter.
Right, and let's just, the consumer banking side of things, for example, that's becoming very commoditized. We as consumers are just looking for a way to never go to a banking center and do our banking online, and for the freest way to do it as possible. And when you look at just the big picture of banks now closing down more banking centers, and that's a trend that's expected to continue in mass over the course of the next decade. I mean, I just don't really see any big argument for these guys.
To paraphrase the world's most interesting man, we don't often talk about gold. But when we do, it's because of headlines like this from the International Business Times. Price of gold in virtual free fall. As you mentioned, Maddie, not a great day in the market. Part of that story is the GDP numbers coming out of China, which are having the expected ripple effect. But yes, you look over the last, I think it's 6 months or so, the price of gold has dropped 20% or maybe even slightly more. I think it's somewhere in the neighborhood of 10% just in the last couple of days.
And it's down $100 this morning last I checked.
Yeah.
Which is quite a drop. It's funny. Yeah, not funny if you're a big gold investor. Sorry. But there's so many things hitting gold right now.
Let me cut you off for a second. It's a little funny.
It's funny for upper.
If you're people who make your living talking about stocks and you've been hearing it from gold investors for the last couple of years, how gold is infallible and untouchable, I'm not going to speak for you or Jason. I'm just going to say for me, this is a little funny.
Making you juggle.
Just a little.
Well, let me tell you how hilarious this is. No. So you've got Cyprus, which we know what's going on in Cyprus. Cyprus apparently has to, forced by the ECB, to liquidate their gold reserves to help pay for the bailout. And so that's happening, and that's sparked fears that Portugal, Spain, you name it, will also have to liquidate gold. So there's that. There's John Paulson, of course, we know, big gold investor, one of the largest hedge funds in the world. He's been getting crushed because he's invested in gold and the gold miners. Apparently, there's fears that he might liquidate. Also, you got to remember, this is people often, especially traders, they buy gold on margin. They buy a lot of commodities on margin. Same with the foreign currency markets. And gosh, when gold takes a hit like this, it just can perpetuate because these guys are sort of forced to cover. They get margin calls. So. And I just think it's interesting. Dennis Gartman, who writes a lot about commodities and gold, he says, I've never seen anything like this, referring to gold's drop over the last week, which coming from him is kind of interesting. So this is just all around. You could pretty much call it a crash.
I blame Twitter. With the free flow of information now. But
there you go.
I mean, so what I think is really funny, and I mean, you read this all the time, is that when people say that they no longer have confidence in the metal, that they've lost confidence in gold.
What does that mean?
What does that mean? It's the same gold that it was 25. Gold didn't do anything.
Right.
It's not as lustering as it was the other day. I need to polish it a little more.
Yeah, it's just not the same gold I knew.
It's the point that Joe Mager years ago when he went on CNBC made, where he said, which is he's absolutely right, gold has no intrinsic value.
Yep.
And we were talking before the taping. It's not like silver where you can actually do something. You can turn it into something else. Gold has no intrinsic value.
It's a perceived value.
And by the way, I'll just use this as yet another occasion to say, go onto YouTube and just type in Joe Mager gold, and you'll find the video clip where just people were just hazing him over that. But it's true.
He's right. I mean, we'd all agree with that.
If anything, this just serves as yet another reminder that I don't know. It's just for all the run up and all the excitement that we saw. And let's be fair, gold had an amazing run up, and there were people who probably made a lot of money off of that. But even then, we were sitting here saying, I don't care about the run up. I don't want to be invested in this.
Somebody gives me a bar of gold, I'm selling it and buying stocks.
Right on.
Radio@fool.com is the email address if you want to take me to task for taking humor in what's happening to the price in gold. Jeff Bezos, CEO of Amazon, published his annual letter to shareholders. And Jason, the overarching theme of this, and I say this as a longtime shareholder of Amazon, is that it seemed like he was defending. The tone didn't strike me as defensive, but it struck me as Jeff Bezos coming out and defending the investments that Amazon has made in Amazon Prime, in the Kindle, and that struck me as appropriate when you consider the fact that for fiscal year 2012, Amazon lost money. I mean, just forget what the stock is doing. In the last year, the company lost $39 million, 9 cents a share. That's how the letter struck me. What stood out to you?
No, I think you're right there in that he uses this letter as an opportunity, as a platform to really sort of give us an idea of what's going on in his head. Because otherwise, there's not a lot out there, on Bezos. But I think that I'm an Amazon shareholder myself, and I understand people who have a problem with the way the business is run because they run on such razor-thin margins, and it seems like the perpetual argument is, well, they're investing in the business. At some point, it's going to kick in and operating margins are going to skyrocket, and yada, yada, yada. And that's fine. And truthfully, I think that Amazon is probably a company that if Bezos were not there, I probably would not own shares. So I'll qualify that as well. But I do think that the one word that came to my mind after reading this letter was proactive. And that's the way he thinks. He is a forward thinker and trying to see problems before they happen and trying to figure out solutions before people really even know that they have an issue to begin with. And I think that's very Steve Jobs-like in that he was giving us things that we didn't even really know we wanted until we actually had them. The quote that stood out for me, and I hope I'm not stealing this from Matty here, but he talks about how he refers to Benjamin Graham, and in the short term, the market is a voting machine. In the long term, it's a weighing machine. And he says, we want to be weighed, and we're always working to build a heavier company. And I think that really tells us everything that we need to know is he is building this company out to more or less put a dent in the universe. And so far, he's succeeding. I mean, if Amazon shut down tomorrow, think about what would happen.
I think it's a brilliant letter. I've read several of the letters over the years, but this I agree with you, Chris. I think this was a little bit defensive. I didn't think
it was defensive, but
defending.
But it seemed like he's like the purpose. I don't know if he wrote this on his own or if he had help, but regardless, it seemed like part of his mindset was, okay, I gotta say a few things about why we're spending the money that we're spending.
No, totally agree. And I have to say, I do like this. To take another quote from this. This seems like a little bit of a dig at Apple. I want to see what you guys think. He says, Our investing approach. No, I'm sorry, it's not our investing approach. Our business approach is to sell premium hardware at roughly break-even prices. We want to make money when people use our devices, not when people buy our devices. We think this aligns us better with customers. For example, we don't need our customers to be on the upgrade treadmill. We can be very happy to see people still using 4-year-old Kindles. That struck me as a little bit.
We're living that model in our house. My wife has a Kindle that's probably about 4 years old. I have a Kindle that's maybe a year old, and then my daughters have their Kindle Fires that they got for Christmas. But yeah, Amazon is making a killing off of the stuff that we're buying on those devices because every day it's something new. And so I think that's people may not really think about that, but I mean the Kindle, for example, just the books alone. I mean, and let's not talk about you and me. Let's talk about our kids, for example. I mean, there's potentially another 60, 70 years worth of books to be bought, on just that Kindle device alone. Right. So, I mean, it really can go on for as far as we can see because I don't know how you improve on that Kindle. I mean, I don't know how that gets better,
The company reports earnings next week. It's on the 25th. What are you guys going to be looking for? Obviously, Bezos has, maybe more so than he has probably since the last letter, sort of shown his hand. And this is like a lot of companies, but Bezos is pretty close to the vest, particularly when it comes to reporting earnings, conference call time. They don't break out a lot of numbers in the way that we would obviously like them to, but that's their prerogative, and so it goes. But I'm just curious, what are you guys going to be watching? Is it any indication of how successful Prime is? Is it overall, is it, that top line revenue number like you were talking about earlier? What are you going to be looking for next week when they report?
Yeah, I mean, for me, I think it's always just the top line revenue for Amazon. I've never been concerned about them, reporting meager profits or lower margins. The street is always obsessed, it seems, with Amazon's gross and operating margins, and that's just, I've never thought that's a great, prism in which to view Amazon. And so, yeah, I'll look at the top line. I mean, I think I'd like to, see if they have any, if you can tell us more about Amazon Prime or Amazon Web Services. Doubt it. But that's to me. I mean, there's not really much you can do. I mean, I also own Amazon, and I've said it before. I just think this company has the potential to be the biggest company in the world someday. It's very clear for me to see that. And so quarter to quarter, and we know Jeff Bezos doesn't pay attention to quarter either.
Yeah, no, not at all. And I think number to go in conjunction with the top line revenue, one that I've been watching for the past couple of years, is shipping costs as a percentage of revenue. And I know there are a lot of concerns out there that they're losing money on their shipping because of all the promises they make with their Prime relationship. And Prime's too cheap and they can't afford that. But if you look at the numbers, they don't lie. Shipping as a percentage of revenue is coming down, which means that it's working. That's a sign that Prime is working. Right. More people are subscribing, and it's a sign. I think that operating margin expansion could be something that is real and that will be happening.
All right, Jason Moser, Matt Argersinger. Guys, thanks for being here.
Thank you.
Thank you.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. That's it for this edition of Market Foolery. Our producer is Matt Greer. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.